First of all, I'm going to give you a little bit of an update of what's going on with INCA Investments. Secondarily, talk a little bit about an overview of the Latin American investment environment. Then I'm going to focus on two countries, one of them Brazil. Brazil is going through a particularly interesting time right now. It's the biggest market in our universe, so I think it always mandates that we talk a little bit about it. And then I'm going to give you a little bit of our views on Mexico. So I'd like to go ahead and get started. This is a little bit about INCA Investments. Right now, our assets under management are about $630 million. About 2/3 of it is in our regional mandate. The regional mandate, as the name implies, is we invest across Latin America. Now, when we talk about Latin America, and also when I talk about Latin America here, what I'm referring to is Brazil, Mexico, Chile, Peru, and Colombia. You should also know that we invest in Argentina and Panama, but generally speaking, the statistics don't incorporate those two countries. And so that's very important because what I'm not speaking about is Venezuela. I'm not speaking about, generally speaking, Argentina, which is still in a very difficult economic situation. So that's what we refer to when we talk about Latin America. Another third of our assets under management are under a ex-Brazil mandate. Again, as the name implies, it's basically the regional mandate, and we carve out Brazil. And so it's not really even a separate or different mandate. It's in essence a sub-mandate of our principal one. A little bit about our investment philosophy. We are bottom-up. To us, what does bottom-up mean? Bottom-up means that we don't ever think about these sort of macro trends, political trends that are happening. We certainly have views about that. It would be a shame if you have 70-plus years of investment experience sitting around the investment table like we do and to not have views on those things. We think we bring that to the table. But what we don't do is we don't say, hey, there's something particularly interesting going on in Mexico. Let's overweight Mexico. What matters to us is how the macro side is tying into the companies, because it's the company that's going to decide whether we invest in the country or not. We are a fundamental investor. That means in the end of the day, what we believe in is that a company's price will follow its earning streams. It's going to deviate from that because valuation differences. But we are fundamentalists and we look at earning streams. We try to get below average valuations. And that takes me to our next point, value bias. If you get below average valuations, you not only stand to benefit from the earning streams improving, you can also get a valuation expansion, which will hopefully improve the returns. Now, to get these below average valuations, you have to look differently than what the rest of the market is pricing them at, generally speaking. And so you have to have a bit of a contrarian view of the stocks that we tend to invest in. And what we like to generally do is find those stocks that have been what we believe to be overly discounted because the country that they're in, the industry that they're in, maybe the company itself has made some mistakes. But if we believe these are temporary mistakes that over time will be improved or go away, then that's what creates our opportunity. So what that means is that we need to have a longer term time frame. And I think a lot of people talk about the long term. I think we have some statistics to back up that generally speaking we are long-term investors. So why I say generally is because, for example, in 2012, 2013, our average turnover for the portfolio was about 25%. So that means a holding period of about 4 years. Now, in 2014, it went up. It went up to about 60%. And the reason it went up is because a lot of opportunities were handed to us and presented to us, I should say, and we took advantage of them. So we sold some of the better performing positions and moved them into some positions that the team's going to be talking about to take advantage of those lower valuations. So let me talk a little bit about the investment team. It's a little bit hard to see, but the ones that are shaded, that are a little bit darker, are the members that are joining us here in Mexico City. It's now a 7-person investment team. I'm the chief investment officer. Efrain is our portfolio manager, meaning that he helps me manage the portfolios. We don't just have a fund. We also have a few separate accounts. Efrain makes sure that they're run on a pari passu basis. The only reason they wouldn't be run on a pari passu basis if someone on that separate account asks for some sort of special limitation, or there's some sort of sector or type of company that they don't want to invest in. Generally speaking, that doesn't affect our portfolio, so they're generally run on a pari passu basis. He also makes sure that the analysts are meeting what we're asking of them, that's focusing on certain companies and making the sort of progress we expect for them to be doing, because we have a lot of work to always do. The rest of our analysts, I'm not going to go out and point them all out, but I will point out the fact that we have a new analyst, and that's Daniel Pittery. As a matter of fact, he begins with us on Monday when we return. And Brian Straley's not here. He's a trader. Trader for us just means execution. We're not short-term. We're not trying to take advantage of short-term situations. So that's our investment team. This is what we call our quality team. And most organizations, this would be called the administration, this would be called the back office. We call it the quality team because this is what we expect from them day in and day out, to make sure that they're doing an accurate job of reporting of how our portfolios are doing, that we're managing the portfolios according to their mandate, and that if the clients have a request, that we make sure we're trying to meet those in a fast and responsible way as possible. And that team is led by Dave Bordenstein, who's also here. Like the investments team screen, the people who are here have been, we've darkened their boxes, and so we have 5 people on the quality team side of the equation. So that means we have 12 people. Now, we think we're pretty adequately staffed to certainly handle the assets and be able to handle some asset growth with both the investment team and the quality team. But I would tell you that our policy has generally been that we're always looking for good people, and if we find someone that's good, then we'll certainly consider bringing them in. That decision has not been made by me. It's made by entire team. And so again, this could change. We could grow. Generally speaking, we're not really looking. But again, when you find good, talented people, we'd like to find a way to make them part of our team. Now I'm going to talk about what matters certainly to the clients, and that's the track record. I have the track record here of our fund. It goes back to the beginning of 2008. That means really basically 7 years and 1 month, where we don't have February included in, or obviously the month just ended, but basically, you can see that 4.5% is certainly not why people came in to invest with us. And we're going to talk a little bit about what's created such a dismal long-term performance, or at least a 7-year performance in Latin America. We certainly have done better than our index, which is our bogey, which we think is the MSCI Latin American Index. We've certainly done better than our peers, at least this peer group, according to the Morningstar Latin American Fund universe. But you can see, and indeed the last 7 years have been a difficult time for equities, generally speaking, and you can see it here through the other emerging markets side of the equation. They've had a very difficult time, and even the large developed markets have had a difficult time. Certainly the star performers has been the American market, the S&P 500. And having said that, that's mainly happened, you can see, from the last 3 years, as the U.S. market has done really very well. And so certainly not also what people expect from emerging markets. Everyone understands that emerging markets, it's a riskier, more volatile part of the world, and that you should be expected with higher returns. You need to go to a little bit longer period to start seeing that come through. So if you just go and add 3 years to that and start doing 10-year periods, and you can do these consecutive 10-year periods for a long period of time, the numbers start changing. And so you can see now Latin America is now at 133%, and you can compare it to the other emerging markets part of the world. It was outdistanced by Asia in this case, but not by much. And you can certainly look at the developed markets there, which have not done as well as Latin America. So over longer periods, we think certainly it's still valid that the emerging markets should be able to bring value generally as an asset class to the investment equation. Now, I'm going to show you, and I apologize for the smaller numbers, but there's a lot of information. We wanted to give you all the detail because to us, this is how we evaluate ourselves. And what we do is the end of this year, we look and we say, how did earnings change? What did earnings do for our portfolios for any position that's been in the portfolio for longer than 6 months? And so this is how earnings went up. And I'm sorry, we kind of had a place where it went over, but that's 19.6, and that's just a simple average. So if you take all of our positions that we held over half a year, they went up 19.6% in earnings. And so we're certainly satisfied with that. That's what we're looking to do. We're looking for them on local. Why local? Why not dollar earnings? Because we understand hard currency, whether euros or dollars, are what's generally important to our clients. The reason is on a short-term basis, we generally don't have views on currencies. We certainly, so what we focus on is just focus on the local side of the equation. The currency equation does go into our thinking, but it goes into our thinking on a longer term basis and how that affects the franchise and the earnings revenue power of a company. If you take our earnings stream and you change it to dollars, then you get a lower number, obviously, because of strengthening of the dollar, 14.8%. If now, let's go look at the markets. What did the Latin American markets do in 2014? On the local basis, they went up 7.4%. Again, you take the strengthening of the dollar, and it went down negative 5.6%. So there's a dichotomy here. Certainly there's a dichotomy in what we were doing at the 19.6% and the negative 5.6%. Part of it, obviously, is the dollar. But the other part of it is that the market went down in spite of for our portfolio, went down in spite of the fact that our earnings went up, even though they went up less on a dollar basis. So there's only one way that can happen, and the only way that can happen is if valuations get lower. So the question is, why are valuations in Latin America getting lower? And so that's what we're going to try to address in the next few slides. First of all, let's just look at it from a big picture viewpoint of GDP growth. So if you look for the last 3 years at least, and you look at Latin America, and this is just a simple average, but you can see that Latin America's actually done okay, 3.3%. Certainly Latin America, any emerging markets country needs to be growing 4% plus to really be improving the economic lot of its people. But it certainly has done better than the developed markets. Here we have the Euro area and United States. So it's, at least for the last 3 years, it's actually been a better performing part of the world. And then what are the expectations according to Bloomberg consensus? We don't know if this is going to happen or not, but this is expectations of generally a big group of relatively smart people. And you can see that actually Latin America is expected to do fairly well. Obviously, the laggard on both of these, on the historical and the expected, has been Brazil. It's been very weak, and we know Brazil's a big part of it, so if we did a weighted average, certainly this will come down. But nevertheless, the point is that the expectations for Latin America from here going forward are not dismal, at least not from a top-down view. And so what is it that's making people nervous about Latin America? And if you're like me and you can remember the 1980s, which was a dismal period, and I think some investors certainly do remember it, and they judge Latin America against that. It was a time where Latin America had huge public debt loads. It had very low international reserves, and it was basically fiscally irresponsible. It wasn't unusual. Certainly, fiscal deficits over 5% in many cases would go over 7 and 8%. And that's how we end up in the horrible situation in the 1980s. The good news is the 1980s, that crisis decade, is what becomes, it turns into the 1990s, where we see a new type of government coming into Latin America, basically under democracy. But I think a lot of that thinking is still instilled in a lot of investors of how they treat Latin America. And so let's talk about those particular issues. So leverage, which is debt, we're going to look at it not just from the public side of the equation, but equally important, we think, from the private side of the equation. And so the Latin American countries we kind of put in this green box, and you can see that, relatively speaking, debt levels of Latin America, and the gray ones are just the numbers for the public side of the equation, relatively low. Indeed, the highest country debt is Brazil, and it's only about 50% of its GDP. These were numbers that were easily over 100% if you go back to the 1980s. And then if you look at the private debt of this situation, again, relatively speaking, Latin America is a place of relatively low debt. So this is not the Latin America, or how they say, this is not your mother's Latin America. This is not your grandparents' Latin America. This is the Latin America right now. And leverage-wise, it's a relatively conservative place to be. International reserves, you can see certainly they don't have the reserves that some of the other emerging markets, but they're very good reserves. Countries like Chile and Peru, over 100%. That means they can literally pay from their reserves all the external debt, hard currency debt that they have. And most countries are on that 50% so level. In the 1980s, when we had our real crisis, when it was a real slow growth environment, we were talking about international reserves that many times were below 10%. And so we can certainly pay the debts that we have outstanding. And the way you see that is look at the spreads on the bonds, on the sovereign bonds. When we talk about the major Latin American countries, the spreads are relatively stable. Certainly the spreads are not pricing in a crisis or a very weak economic growth environment for Latin America. And the next part is fiscal deficit. So again, Brazil, it's a little bit more difficult situation, but even including them in, you're talking about 2.4%, not great. They could be lower, but not unusual for emerging markets country. And you compare it even to the developed world, they're certainly lower on that side of the equation. And so it's not the Latin America that I think a lot of people think of the highly indebted Latin America of the past. Now, there's the commodity issue, and certainly that is an issue. And so we made this chart to kind of break it out for you. And the first thing you should notice that I think a lot of people know, but don't quite realize how Latin America is not Asia. Latin America is not a part of the world that really moves forward by exporting. Okay, and you can see how low a percentage it is. Only 20% of its GDP is related to exports. In Asia, it's not unusual to have it over 50%. Now, out of these exports, most of them, or half of them, are on the commodity side of the equation. You do some simple math, you get about 10% of our GDP is tied into the exports of commodities. Now, I think commodities, you know, is a very wide word. So we break it down into the specific exports that are important to each particular country. Certainly the one that stands out is Chile, with about 17% of its GDP tied into copper exports. But you should also understand copper's been going down for quite some time now. And it's largely based on construction in China or just economic activity in China. And so certainly the prices of the commodities can go down, but that should somehow tie in to be consistent to a China view that you have that's going to be a much slower China than we've seen, than we currently see right now. And the other thing to just know about Chile is Chile has a sovereign wealth fund that's created and is set to balance weak copper prices. So they have a sovereign wealth fund about 10% of GDP. So if copper prices go any lower, they can actually start kicking in some counter-cyclical measures. And the other thing about Chile is acknowledged to be the best managed, strongest economy within Latin America. Now, if you keep going down to Peru, Peru is much more diversified. It's actually been growing very nicely on the agricultural soft commodities. But you can see copper is 4.3%, and I apologize, we have a typo here. That says 8.9%. That's incorrect. That should be 3.9%. So oil is important, copper is important. It's a little bit more diversified. But Peru relatively has slowed down on certainly its GDP growth. It's been a negative for it, but Peru continues to do pretty well, and most expectations are that it should continue growing about 3%. Colombia is affected by the oil price of the equation. You'll be seeing that effect, and their GDP will be going down as they have to tighten their fiscal spending, certainly, and control their current account deficit. That'll increase. But again, generally speaking, Colombia is considered a country that's relatively well managed. The problem with Colombia has never been really the business side equation. It's been the civil unrest, which it seems like there may be a peace plan that finally ends it after decades of unrest. But even if the peace plan doesn't go through, I think everyone can acknowledge that the civil unrest situation that Colombia had 10 to 15 years ago is not the same situation that they have right now. Much more stable country. And then I'm going to skip on over to Brazil. I'll come back to Mexico. Brazil, actually relatively low exposure to its commodity side of the equation. Brazil was helped when commodities improved, but what really helped Brazil was internal consumption increasing from the years of about 2003 to about 2000, really all the way into 2011. In 2010, Brazil grew 7%. And so that was mainly through the consumption side of the equation. And so not a factor, again, in all these countries factors, but different degrees of how detrimental it is. And then we talk about Mexico. In Mexico, 4.2%, certainly the oil is going to be important. Your headlines today will read that the government's going to have to cut spending further. It accounts for about 33% of revenues. They're being very proactive because actually they have most of it hedged for 2015, but certainly it's going to start, that hedge starts going away in 2016. So Mexico's always done a very good job of managing their economy and been in a very fairly conservative inflation fighting central bank there. They're going to cut spending because they don't want to take any chances. And so it's certainly going to be a detriment to the Mexican growth, at least for the next couple of years. But we would say, but not the driver. And if you look in the yellow, the reason we put it in yellow is that is manufacturing or non-commodity exports. And you can see it's the only country in Latin America that has within the top 5 some exports, and it's very manufacturing exports are a much wider variety and range, and that list could go on forever, and that's what drives Mexico. The exporting of manufacturing goods, where to the United States, where over 80% of their exports go to. So look, we understand commodities, negative, largely already affected these countries, but we're not in the same situation that the commodities going down create some sort of crisis scenario for Latin America. Only 20% of the GDP, if it's not exports, what is it? It's domestic consumption. So we're going to talk a little bit about domestic consumption and why we think that continues to improve in Latin America. It's been improving. We think it will continue to improve. Demographics. Very, very powerful force. And so we put Europe here because that's a variety of countries as opposed to the United States, but you would find that the demographic pyramid of the United States looks very much like that of Europe. Indeed, Japan looks very much, and China looks somewhat like that one. But Latin America has a very different demographic curve, and what you see is you see the demographics in purple or blue in 1995, and you see where they will expand. So the expansion is the red area by the year 2025. And what you'll see is a very young population here. Where's it expanding? Right in these particular columns. Where the developed countries expand? In the older generations, okay? And why is that important? Because these are the consumption years. These are extremely favorable demographics for consumption. Only one part of the world that shows better demographics, and that's Africa. And that is a younger one. Now, just because you have a young population does not mean that you're going to have a great growth and prosperity ahead of you. You got to take advantage of it. I went to listen to a demographics expert one time, and he spoke about the Arab Spring. And he talked about that, in particular in Egypt's case, it was not about religion. That's not what's driving things in Egypt. What's driving them, he would argue, demographics. And he would say that the demographics of Egypt look very much like Latin America, and what happened is they started getting a lot of people coming into their 20s and their 30s. And he said when you have that, there's really 2 paths for you to take. One is you give those people an opportunity to have good jobs, and you're going to have an economic boom because you're going to have so many young, productive people. If you don't, and you don't create an opportunity, which is what he says really was the driver in Egypt, you have a revolution. And so that was his case. And we would make the case that these favorable demographics, with an improving Latin America on the economic side, is certainly going to be for an improvement on the economic side of the equation. We'll point out some of the reasons. One of them, we've already seen an expansion of the middle class. We think that's going to continue. The growth of the middle class, first of all, just has to be driven by economic growth. And let me talk about economic growth. And for us, it's a very big picture topic. And it's a long-term topic. And it really goes back to what I was referring to, the 1980s, when we basically had a decade of negative real economic growth for 10 years. That's kind of what a Greece may be looking at. It's a horrible situation. It's a crisis situation. Generally, the good things about crises are that you're forced to make decisions. And by and large, Latin America did make a decision. It was also helped by some plans that were implemented, namely the Brady Plan by United States. And so what it is that reduced our debt, but they expected democracy in return, as the United States no longer really feared the way they used to the communist increase. And they were really, along with the local populists, they were supporting basically autocrats and dictatorships. We moved into democracy. And the importance about democracy is accountability. And it's almost something, when you go look at the history of Latin America, that's been almost absent from our history. So we've had real accountability, and that's what I attribute the improvements that we've been seeing in Latin America, and we think that's going to continue. Because accountability means if you have open democracies, which in Latin America we do. Again, I'm not talking about Venezuela. I'm not talking about Bolivia or Ecuador, where the press is generally managed, where maybe Venezuela, where the elections seem to be corrupt. We're talking about open democracies within the countries we invest in. We're talking about open media, and that means if you don't do a good job managing your economy, you know what? You lose the elections. So there's an accountability factor there that we haven't had a long time. Been responsible for a lot of good things that happen in Latin America. Will continue to be responsible for those things going forward. We've had this decline in inequality, was certainly important for driving consumption in Latin America. More efficient tax systems. One of the most important things that has happened in Latin America is moving people into the formal sector. If you think about this country right here, over 50% of the workers are still under the table or in the informal economy. And you saw an example of what's happening yesterday. And that is, when the COF guys took us to these little stores, these little bodegas, these kind of corner mom and pop stores, I can assure you no one there was registered with the government or paying taxes. Okay, but then you walked over to FEMSA and you saw the not FEMSA, but OXXO. Okay, I can assure you that's a completely formalized sector. Now, where do you think Latin America is going to? The guys winning market share are the OXXO guys, and they're bringing people into the formal economy. When you bring people into the formal economy, you have them now paying taxes. The tax percentage in a country like Mexico is only 18% of GDP, in spite of the fact that individual taxes and corporate taxes are not low. It's that they're not getting taxes from people that are working in the black market. That's going to start changing. That's going to start increasing revenues. And the importance of that is that it's going to make for a better redistribution system. Again, governments are held accountable to not having good, efficient programs, and they understand that. And you saw an example of that. You saw that when people took to the streets in Brazil. What were they doing? They were complaining. They weren't looking to overthrow the government, but they were looking to send a very strong message, and that is, we don't like the way you're managing our economy. We don't like the way that you are basically your distribution systems. We don't like the transportation you're giving us. We don't like the infrastructure you're giving us. We don't like the health systems you're giving us. That's people making their voice be felt. Governments understand, and they have been improving how they distribute the taxes that they collect. So we think that that's going to continue to be a driver, the economic growth, with better management of the governmental systems to help continue to increase the middle class in Latin America. Now, someone can choose to believe me or not believe me on the story about an increase in consumption, but I tell you who does. It's not that they believe me, it's that the way they're investing their money, and that is foreign direct investment. Foreign direct investment has a time frame, generally speaking, of 10 years plus on their paybacks, and you can see what's been happening since really since 2006 is when we begin taking the numbers. Basically in 2006, 57 billion, now over 3 times. It's tripled the amount of FDI going in Latin America. These are the people who have to know their business, generally consumer-oriented companies, whether the Nestle's of the world or the Hormels of the world or the car manufacturers of the world. They're putting plants, and they believe that consumption is going to pay off for them in Latin America. And let me tell you who else. Private equity. Private equity, you think, with a little bit more like a 5 to 7 year time frame. What were last year? 10.4 billion that they raised. That's a record amount. So these guys who are thinking a little bit longer term, they believe the Latin America growth story and the consumption story in particular. The portfolio investors haven't bought onto that. Now, that's because they can wait. But waiting, sometimes you wait past the best opportunities. And so basically for the last 7 years, we don't have 2014 here because those numbers aren't available for foreign direct investment yet. But my point is that the longer term money does believe in the consumption story of Latin America. Now, I'm going to talk about the 2 countries. One of them is Brazil. Brazil, generally speaking, you can see what happened. They had certain boom years. The stock market went up tremendously, but then we've generally had a slowdown. And so the slowdown with 1.3% growth for the last few years, and the market coming down. Our view of what's been happening in Brazil. Generally speaking, we think when the Lula administration comes into power in 2002, Basically, we think they did some good things. They were very fiscally responsible. There was concerns at the time that there was going to be a debt default in Brazil. They improved the primary fiscal balance. That's the government balance, their budget basically, before you have to make debt payments. They improved it to 4%, and that convinced the debt market that these guys are going to be fiscally responsible. And then he started doing some other things, and some of those continued going on, and we think that created some of the negative ramifications, had good short-term, but not good long-term. And one of the things that he did was he increased minimum wages tremendously. Now, a lot of wages in Brazil are indexed to those minimum wages. So wages went up way more than certainly productivity, which actually has remained relatively flat in Brazil. And when you have that happen, you not only create an inflationary environment, more importantly, your industrial growth isn't going to expand because you cannot be competitive on a global scale. And that's what, if you really see the industrial side of Brazil right now, it's the part that's really suffering. And so Brazil largely becomes uncompetitive as far as industrial goods, and not just the export side, because again, not a big export country, but what happens is the imports start becoming way too competitive, and then you hurt the industry that's making domestic-oriented goods. There's a tremendous increase in lending by public institutions. And in Brazil, this doesn't mean just the private banks. This doesn't mean just giving money to individuals via housing programs, which certainly creates some good, because certainly we can agree that there has to be an improvement in housing, especially for the lower echelons of Brazil. But they started giving them loans so they could not only just buy their house, but buy their furniture. Maybe buy TV, and that's just really not a productive use of government revenues. And on the business side of the equation, the BNDES is a huge, the biggest single lender in Brazil, and they generally lend at below market rates to very big corporations. So we relatively consider it business welfare programs, commercial welfare, and generally speaking, it's the government choosing who's going to do well or who's not going to do well. We don't generally think that's a very good idea to do, and it's had real ramifications. The government then, as inflation started becoming a problem, they decided that the way to do it would be put the heat on the private companies, forget the public companies. And they did use the public companies. Obviously, Petrobras was not allowed to put oil into market rates, but they took on like the major industries like the banks, and forced them or try to keep their interest rates going low by increasing government institutions that lend, which used to only account for about a third of the lending in Brazil. Right now, it accounts for over 50%. And so that's put a hamper on the bank side of the equation. And then the other thing they did is, for example, they slashed utility rates. And so that's going to have long-term ramifications for the energy side of the equation, because no one's going to want to invest in a country where you can't get a good return on your capital. So this had been going on, but what happened was you really started feeling the ramifications in the economic downturn in 2012, in 2013, but then 2014 comes around, and you could really see it. And what happened is the government had a decision to make, but the presidential elections were coming up, and their decision could have been, hey, we need to change how we're managing our economy. Instead of doing that, they held on, and things got worse. And then after the elections, because as far as an election policy, it was successful. The current president, Dilma, was reelected. She was more of an interventionist, we would argue, than even Lula was. But after the elections, what she realized is she had no choice now, and that she had to become more fiscally prudent and start getting the government out of managing the economy of Brazil. And so she's done some good things. And so she's appointed a gentleman, Joaquim Levy, to be the finance minister. And the first thing he said was, and he's been pushing presidential decrees, in essence, to lower the expense ratio. So now he's going to be cutting the fiscal deficit by about 1.4%. Mind you, that's only going to get you to about 1% primary surplus in Brazil. Remember, under Lula, when it first started, it was 4%. So they still have a long ways to go. And then basically, they've also been raising interest rates. The central bank is, and indeed, they just announced, and it's now 12.75. Think about it, a slow-growing economy in this kind of environment where you see a lot of interest rates going down. In Brazil, they're actually having to go up. Obviously, interest rates going up and the government stimulus going down, you're going to have a difficult time on the short term. We think these are good long-term policies to implement for Brazil, but there's going to have to be some pain to be paid for that, and you're seeing that. Expectations are the economy could be negative this year, and somewhere down the line, we think they're setting a good foundation, but in the short term, it's a bit concerning for us what's going on in Brazil, and I think to most investors, and that's why Brazil is not performing very well. And our policy basically on it is that if we can find great franchise companies that we can feel comfortable holding for the long term, we'll buy them if we can get them at a very good rate to account for the fact that this could be kind of money that doesn't do very well for a few years. So it's limited what we do in Brazil, but when we get our opportunity, we certainly like to take advantage of it, and we're going to be talking about one of those opportunities. These Tatiana will be talking about one that we feel particularly optimistic about. Now let's talk about Mexico. And this is, we have a graph here, Latin America, the US, and the red line is the border. That's a very unique border. You'll never see a border with a developing country against the developing country. The only exception to that, but it's not near as important commercially as the US-Mexico relationship, is Germany with Poland. And so my point is that this is what we think is the driver for Mexico. Now, hasn't always been a good thing, be U.S. neighbors. Indeed, half of the Mexican territory is now owned or part of the United States. So that leads one of the historical precedents of Mexico to say, poor Mexico, so far from God, yet so close to the United States. And but we think going forward, actually, now there's going to be some real benefits to Mexico being next to United States. And so first of all, let me give you a little bit of background. Mexico that you see now wasn't in Mexico about 12, 13 years ago. So you can see that Mexican GDP was actually higher than Brazilian GDP. And you can see now that's certainly not the case. It's only about half. And then if you look even within the index, and I certainly remember these days, and that is that Mexico is actually the biggest part of the Latin American index, and certainly not the case anymore. And so generally what happened is very low economic growth in Mexico. Indeed, for the last dozen years, about 2%. That's dismal growth. Certainly the weakening of the peso, and the real is actually, in spite of the fact that it's been weakening a lot, the real has strengthened quite a bit. And so those two things are what kind of changed the economic leadership of Mexico to Brazil. But obviously also Mexico is a much larger country population. I'm sorry, Brazil is than Mexico. So we're not really saying that Mexico goes back to leadership. But what we are saying, and what we believe in, is that Mexican economic situation is going to be improving going forward. And why is that? First of all, let's look at what we think are the causes. And that is in 1994, historic moment for Mexico. They opened into the NAFTA treaty, and that actually worked very well for them. You can see that the growth was about 5.5% after the NAFTA treaty. But then what happens with this trade? China started developing and becoming an industrial powerhouse and decided that they were going to come in and they were going to be a manufacturing machine. Why? Because they had so low wages back then. And indeed, most studies would show that Chinese wages is about 1/3 to 1/2 of what Mexican wages were. When they come into the WTO, they get preferential tariff treatments, and all of a sudden, Chinese imports, and particularly the United States, start really coming into the market a strong way. That is Mexico's market. Mexico started losing market share of U.S. imports into Mexico. So what helped China and helped commodity prices and helped a lot of Latin American countries hurt Mexico. And so Mexico started suffering from, and you can see right here, from here to there, you have about 13 years. Mexico GDP, 2.1%. Again, dismal GDP, long-term GDP growth. On the political side, something else interesting happened too. And that is basically under Ernesto Zedillo, he decided that he really needed to open up to real open elections in Mexico. He made sure that all of a sudden that there wasn't the same sort of clientelism that we have between the big unions, the big corporations, and the pre-party. He opened it up. After 71 years of PRI rule, which some people call the perfect dictatorship, the Mexican electorate said, you know what, we want to change. And they voted in the PAN party. Now, the breakup of Mexican politics are that you basically have three parties. You have the PRD, which is the left-center party. You have the PAN, which is the right-of-center pro-business party. And then you have the PRI, and they are morphing. They have been very populist. They privatized banks. They privatized the oil industry in history. But yet, these are the same people now that are actually taking very strong pro-business economic reforms. But what happened when the PON came into power, the PRI decided we're not going to cooperate. These guys wanted to push through reforms, but they only controlled about 1/3 of Congress, so they couldn't do it by themselves. So the PRI lined up with the PRD and said, no, we're not going to allow you to do any of these reforms. You had stalemate. Nothing particularly happened during the 2, and these are 6-year terms. So for 12 years, a dozen years, there was really no political progress being made in Mexico at the same time that the economy was doing horribly. So these are the 2 factors, and now we'll talk about why we think these things are changing. And the first is the wages. So here you can see this particular study had wages back in the year 2000 of Mexican wages, 1/2 of those of Mexico. Chinese wages, 1/2 of those of Mexico. You can see what's been happening up. Chinese wages have been going up tremendously. Why? Because that's the whole purpose of having economic growth in China, so that the people would be able to move up their standard of living. So wages, generally speaking, have been going up at double-digit rates for quite some time now. And you could see where they're expected to be in 2015. Now, all of a sudden, much higher than Mexico's. The other part of the equation is the strengthening Chinese currency, while at the same time the Mexican currency has been devaluing. And so all of a sudden, this competitive advantage that China had against Mexico is gone. And now Mexico has the manufacturing competitive advantage. But Mexico also has 2 other things. And that goes to the original map that I showed you, and that's location, right? So think about how much cheaper it is to bring something from Mexico than shipping it over from China. So transportation costs are considerably cheaper for Mexican manufacturers. And then time. It takes about 3 weeks to get things, at least, from China, generally speaking, over to the United States. From Mexico, generally speaking, 2 days. A very efficient road, very efficient railway system. And that's really important. Think about technology. Think about how quickly technology is moving these days. Think about fashions. Think about something hits and it's popular. People want to have that on the racks very quickly. So this time advantage is very important. Think about car manufacturing, just-in-time delivery. Holding inventory is a cost of working capital. So this location advantage for Mexico is very important. And so what has been happening, what have been seen? Again, the share of imports into the United States from Mexico is going down at the same time that China's has gone up. But now what we're seeing is the bounce back of the Mexican wages, and we think of the Mexican exports to the United States, and we think this is going to be the real driver again of Mexico going forward. And particularly, let me talk about one industry that accounts for about 25% of the exports to the US, and that is the auto industry. So you can see the Mexican auto exports have been growing at about 9.1%. And that is a combination of cars that are fully manufactured and also parts, which are also a very important area for Mexico. And you can see what the expectations are. And that is this: when you look at the majors, the big car dealers, car manufacturers or assemblers, as we call them, you can see that growth is actually expected to increase, okay? And why can we be kind of sure about this? Because the facilities are being put in here, okay? All the time, we're all constantly seeing clippings of someone new has decided, lately Kia, who had never been in Mexico. But now Nissan, for example, is making more Nissans in Mexico than they do in Japan or anywhere else in the world. So we constantly are seeing new companies being built or proposed to be coming into Mexico. And indeed, Mexico is now expected to surpass Canada as the #1 exporter of cars to the US. It just surpassed Japan. And it is also it was about 8th a few years ago. As far as a world producer, it's going to be moving up to 5th, overtaking India fairly soon. So this, we believe, are some statistics that are kind of making what we think is the case for the increase in manufacturing for Mexico. And that's going to mean better wages. They're going to be gradual, but it's an improving employment environment and an improving wage environment. And here's why we think consumption is so exciting in Mexico. And that is when you look at Mexico, look to see how low in loans there are. So financial intermediation is extremely low in Mexico compared to other Latin American countries, and certainly compared to other more developed countries. So there's a lot of potential for leverage there. The banks haven't felt very that they want to go into consumer loans. Why? Because it's been a very slow economic growth time. But that's going to start, and that mentality will start changing. And also, consumers, they certainly don't want to go into a mortgage when they don't feel comfortable about their employment opportunities. But as the consumer confidence starts picking up, there's going to be the opportunity for mortgages and consumer loans. It'll benefit the banks, it'll benefit the consumers, and it'll benefit consumption growth for Mexico. And so we want to talk now a little bit about the political side of the equation. The new president, Ernesto Peña Nieto, comes into power and from the PRI, and he says, look, we need to propose and pass some reforms in Mexico. Okay? And he's had a remarkably good time doing it, or success doing it. Why? Because the PAN party, the right of center party, has decided that they're gonna, in spite of the fact that the PRI was obstructionist, they want these reforms, they're gonna work with the PRI to have their reforms. Now, to pass some of the reforms, such as energy reforms, you actually need to change the Constitution. You needed 2/3, and they were able to get 2/3, okay? That's how strong the consensus is in Mexican political circles right now to make some improvements to the Mexican economy. On the labor side of the equation, they basically increased labor mobility. So it's going to be much easier to actually hire workers and actually displace them when your business isn't doing well. What that's going to mean is that's going to get more people out of the informal economy and into the formal economy. Education was horrible in Mexico. It still is. It's in the beginning stages. But at least they have the union here, the teachers union, had a stranglehold on education here. And now they've really kicked out, they imprisoned the leader of the teachers union, and they really are trying to get the government to take back control of the education system, which is so important in Mexico. On the financial side, they say we have to make this, it's not competitive enough. We want more competition on the banking sector. A lot of countries, when they think of that, what they do is let's put a ceiling on how much interest rates you can charge. That's the government interventionist way. Or maybe let's put pressure on from the government banks. What did Mexico do? Mexico said, we need to lower the cost. You know how we're going to do it? We're going to make bankruptcy much easier, much more efficient, improve the judicial process for that. And that's going to lower the cost. Why? Because you can get your collateral back. A company can go bankrupt, or we can force them into bankruptcy, we can get our collateral back. That lowers our costs. If it lowers our costs, that should be passed on to consumers. This is kind of the open market thinking of the Mexican government. Telecommunications, you saw it from América Móvil yesterday. Those of you who attended that part of the conference yesterday saw América Móvil talked about the increase where they've been called the dominant provider, so they don't get to do certain things, or they have to charge different tariffs than if they weren't the dominant provider, and that's them trying to increase competition there. And that's a very important sector, obviously, telecommunications and what it implies for internet access. And so they're trying to create, in telecommunications, in banking, in media, more competition that they've traditionally had. I'm going to skip down here to the energy sector, and perhaps the most important one, which they had to change the Constitution. For decades now, this has been the Mexican Pemex company could drill and look for oil in Mexico. Mexico is a very rich oil country, has some great reserves offshore. But 70% of the revenues that Pemex made went to the budget. So two things were happening in the energy sector in Mexico with Pemex. One, they didn't have any money to do research and development to look and explore for new reserves. They had enough money to pay workers, that's it. And so that policy to fund the Mexican government was creating a inability for Mexico to grow its energy resources. And also the union. the oil workers union, where the guys kind of running the shop there, they didn't have any foreign competition. They became, especially the union leaders, very rich people, and the Pemex was a woefully run government institution. Kicked the unions again out of the board, out of Pemex, and they said, now we're going to have open competition. If we can enter into a contract, the government, that allows a foreign company to drill for oil, and that's going to make it a much more efficient and competitive system. And indeed, you, Pemex, don't have to pay 70% of your revenues to us to fund our budget. So they cut that down, so Pemex actually has higher exploration budgets. Now, the carry-on effect here is on the fiscal side. Less revenues from Pemex, the government needed to do something and increase revenues, and they increased taxes. And this taxes has had an impact on Mexico. Mexico's grown about 1.6, 1.7% last couple of years, largely because because that's actually created a situation where people weren't feeling real optimistic about the economy. Now taxes increase. Kind of hurt the situation. Hurt it short term, but certainly long term, we think that was the way to go. And so now the tax has been largely been absorbed, the impact had been absorbed, and we should expect now that these things will slowly start to improve the economy. The cost of this has largely been borne out, and we think now from the manufacturing side of the equation, things are going to start improving. So generally, our view here is that Mexico has a very market-oriented government that's going to serve Mexico very well. You should know Mexico has more free trade agreements with more countries than any other country in the world, and that forces you to be competitive. We think that the growth is going to be largely manufacturing growth, and that's going to, in turn, going to increase wages. That's going to take a low consumption environment and certainly be able to strengthen it, which is going to be also amplified by the increase in credit. And we think the newly enacted reforms are going to have very good positive long-term implications. So with all of this, we have a very favorable view on Mexico. Hopefully you're seeing some of it during this trip. You would see it within our portfolio. We're always looking to invest in good franchises in Mexico when we can certainly get them at good, attractive valuations.